Debit spreads versus credit spreads. These are two option strategies which are actually quite similar when it comes to the profit and loss diagram, but they have distinct advantages and disadvantages in market conditions. And what these are, we're going to discover today. And the way I thought we're going to do it is we're going to be very, very practical. I'm going to go through a very hands-on example. This hands-on example is, in fact, the symbol USO, the United States Oil Fund. I'm going to show you in a second what I mean by this. But before I do, I want to introduce to you really quickly a tool which we will be using for this. This is a tool which we don't own. It's not our tool, but I really like to use it. It's called Options Strat, a tool which allows you to simulate an option strategy, to understand fully where's my risk, how much am I risking, how much can I potentially gain, what happens when, for example, my volatility changes or my price level changes and so forth. It's a great tool, and this tool is on sale right now. They have a memorial special going on. And if you want to try it out, there's a shortcut here. It's tradingindicators.com/strat. Great tool. I'm going to be using it today to simulate the benefits of doing a credit spread versus a debit spread. But as mentioned before, we're going to ease into this in a very practical manner. So how do we do this? Well, let's take a look at USO, the United States Oil Fund. I'm going to recap real quick. What do I see right now with this symbol? So this is what I see. I see that this is a daily chart. Okay, so USO daily chart. We are in a bullish trend as per our MA Rush indicator. And within this bullish trend, starting from, I would say, March this year, the symbol has been more or less in a parallel trend channel. You can see it here. And every time the price approached the upper end of the channel, this could have been an interesting short opportunity, even though I don't really like to go against the trend, which is bullish. And every time the price came down to the lower end, you can see it here and also here, this was in the past an interesting long opportunity. And look where price is right now. Prices came down, this is today's price data, towards the lower end of this trend channel, currently trading at around 137, which coincides with this lower end of this trend channel. And our trend is bullish. So I think it would not be completely unreasonable to think, okay, potentially we may see another bounce off this lower end of this trend channel. And we could trade this. This is a tradable setup. And I think there's some merit to it. But the question is, how should we trade it? And in particular today, how could we or should we trade this with options? Because there's some distinct advantages and disadvantages depending on which options strategy you are using. So how can we trade this setup using options? Let's explore this a little bit together. Before we do, a couple of key considerations. First off, USO is very volatile. Oil has been extremely volatile thanks to the geopolitical tension that's going on right now. There have been huge moves in the oil price. So if you go back here, just real quick to my chart, you can see how huge these moves are, jumping up, down. Daily swings of a 5%, 8%, 3% are not uncommon. So this symbol is very volatile, and the implied volatility, like the expectation of the market, how much volatility we're going to see moving into the future, is also high when it comes to this particular symbol. Not every symbol has this high volatility, but USO does have high volatility right now. So it's very volatile. All right. Second consideration. We are in an uptrend. Absolutely. There's an uptrend there. But this is my personal belief. You don't have to share it with me, but that's and of course, as a trader, you always have personal beliefs. My personal belief is in the long run, and despite the current uptrend, the price levels at which we are right now, they are not sustainable. And a correction to the downside, in my view at least, is just a matter of time in the long run. Nonetheless, in the short term, I believe there is a good chance we're going to see a bounce of this level. But this is more like a short-term perspective. In the long run, which goes out multiple months, maybe a year, I believe you're going to see lower price levels. But in the short term, I think that a bounce is not unlikely. So let's just keep this in mind. So it's very volatile, and in the long run, my outlook is not too bullish for this symbol. But in the short term, it is. Let's keep this in mind. So what can we do with options? And one way to do it is, for example, hey, why don't we just buy some call options? Let's say at the money call options. Let's see how this would fare. All right, so I'm going to switch over now to our tool options strat to show you how this works. So an options strat, what you can do, you can use this little build menu here and pick one of the predefined option strategy. I'm going to start really simple. What if we just put in a long call option? We're going to buy a call option. That's what it means. Long call means we're going to buy a call option. So what we can do then is we can type in the symbol name here, USO, as already typed in. It's loaded, the United States Oil Fund. We can see what is the current price right now at 137. And we could simulate, okay, if I were to buy a call option, let's say with from the shorter term perspective, we have 1 month to expiration, June 18, at the money, current price is 137.90, at the money around will be 138. We can see it here. We would pay for this call option right now approximately $930. That is expensive, not just in absolute terms. That's $1,000 that you have to fork up. So if you have to, just to have the option to buy this symbol later on at the strike price, that's quite expensive for this. But also in relative terms. Why? Because the volatility of USO is quite high, and of course that's priced into the option premiums. The more implied volatility is expected, or the higher the options premiums are. So to me, that's not really the best idea, because options premiums are very high, and if I want to, buy call options, ideally I want to buy low and sell high. I don't want to be buying already high and then trying to sell even higher. That to me is not ideal. So buying a long call, maybe not the best idea. The premiums are quite high at 940, both in absolute terms and also in relative terms. Absolute terms means that's the big number for my account size, $1,000. But also in relative terms, oil right now is very volatile. I believe that volatility eventually will go down. But to me, buying into this high volatility might not be the best idea. So let's not go down this path. Let's try something else. What if we tried to somehow reduce the cost of the option premium? So right now it's very expensive, like almost $1,000. You can see it here, 940. Let's try to reduce this. What could we do? There's many things you can do. And one way to do it, as I said, I'm going to go through this very slowly. One way to do it is, in fact, to go a little bit further out of the money. So the first example we had was, hey, we're gonna buy call options at the money, at the current price, and they have a certain premium to it. But if you go further out, the options premium will go down. How does this work? Well, let me go one more time to our tool here, options strat, and observe what happens if I move my strike price. I can just slide this around further out to the right-hand side, further above the strike price. So, further above the current market price of USO, which is 137. So let's go from 138 of the strike price to 140. Look at the debit here. Only, in quotes, 842. If you go even further out, let's say to 145, now it's 652. If you go even further out, it's going to get even less. But of course, there is a downside to this. So we have this advantage, okay, it's going to get a bit cheaper for us to buy this. But of course, for us to profit off this trade, look how far the price of USO needs to go up in order for us to only break even. So in this case, for example, the break-even point for a strike price was 150, would be at $155 at expiration. That's quite a ways to go. From 138 to 155, maybe not the best idea. So if I go back to my slides here, yes, we could move further out of our strike price, but if we do, yes, we're going to pay a little bit less. That's why I made this orange here, from red to orange, this little circle here. But our break-even price will also go further out. Not so ideal. All right. So long call options, more out of the money. Yes, it's going to be less expensive, but to me, still expensive at 650 or 670. And our break-even point is further away. Not ideal either. What else could we do? to make our premiums cheaper without potentially moving too far out of the money? Well, we could, in addition to buying this call option, also sell a call option at the same time. We're going to collect some premium if we do this. This can offset the price for the initial call option. How will this work? But what we could do is we could sell a call option which is even further out of the money. Let me show you how this works. So back to our tool here, and now it gets really interesting. Okay, so let me move my strike price back here to more or less break even, 139 here for our first long call option. So we're buying a call option, but now we also want to sell a call option, which is a bit further out of the money. How can we do this? Well, we could go to this Add button here and select Sell Call. I click on it, and we said this call option should be a bit further out of the money, so I'm going to move this a little bit further out. And what you see here is the following. You can see here that our net debit now, the cost of this option strategy, has gone down significantly. Now only 255. That's interesting. You can also see, okay, that in fact, this is our max risk on this trade. This little red line here stays at 255. That's the max risk. Regardless of how far oil will go down, our max risk is what we're paying for this for the premium of this trade here, which, by the way, is called a debit spread or a bull call spread. And what you see also here, if I slide this left or right, you can see how my downside potential is either going up or down, but also my upside potential is changing. So all these values are changing, and you can simulate what to you might be the sweet spot of having these strike prices for the initial long call, but also for the sold call option. You can understand exactly what is the downside and what is the upside to it. This is called a debit spread. And there's merit to this because you will reduce potentially the premium to be paid quite significantly because you're selling also something, not just buying something, but you're also selling something for which you will collect a premium. All right, so let me go back to my slides. So this is the bull debit spread. It will reduce your premium quite a bit, so it will reduce the premium quite a bit. But let's think this a bit further through, a bull debit spread. Now, to me, for this particular trade, there are at least two problems with it. First of all, it's a net buying strategy, a net debit strategy, meaning I still have to buy a premium. And since I'm still buying something and premiums right now are quite high, it might not be ideal in this current environment for USO because premiums are already quite high. So, premiums would need to rise even further for this particular one. And secondly, I remember my short-term time horizon for this trade. The closer you are to, so I don't think, I think this is going to be a short-term trade, a short-term bounce. In the long run, my outlook to oil for USO is not so bullish. So this should be a quick trade. But these quick trades with expirations which are not too far out, they will suffer quite a bit from what is called time decay, which is also not perfect for an options buying strategy because, the value of your options will decay as the closer you get to your expiration in an accelerated manner. So maybe not the best idea in the current market conditions for USO. What are our options here? Well, what if we tried an option selling strategy? This could potentially solve our problems. Let's sell something instead of buying something. The premiums are high. Maybe now selling is a better idea. Okay, let's explore this a little bit. So what we could do is we could, for example, just sell some put options. Now, buying a put option is a bearish play, but selling a put option, that's a bullish play. Exactly what we have in mind for this USO trade. How could this work? Let me go once again to our tool here. So I'm going to clear my trades. I'm going to remove these. Okay. And now I'm going to indicate, okay, show me what's going on if I just sell some puts. Okay. I have it here. At the money, let's say. I'm going to sell some puts at the money at the current price at 138. What will happen then? Okay. First off, you will receive right off the bat, a credit for the sold put of $917 currently. As I mentioned before, premiums are currently quite high. Selling a credit, selling an option might not be the worst idea. You will benefit if prices go up. You can see it here. As price of USO will go up, you will benefit up to the maximum of your entire credit receive. But there's also a problem. Look what may happen if prices of oil go down. And remember, and oil is very volatile. Who knows if oil really is going to bounce off this level? Maybe it's going to plummet through it. Maybe something happened in the Middle East and oil prices will stabilize from today to tomorrow. To me, this is not an option right now, this particular play, because my downside could be so negative compared to what I can gain. Not ideal. So selling a naked put, as it's called, perhaps not the best idea because of the big downside here. Yes, I'm getting a nice credit, but the downside is pretty much, well, it's too significant to me. So what could I do? Well, the risk-reward profile is unfavorable for short puts. And it's not ideal when the long-term outlook is uncertain or there's so much volatility in the market. Who knows what's going to happen? But what if we protected ourselves a little bit? What if we would limit our risk by also buying a protective put further out of the money? How would this work? And this brings us to the credit spread. So let me go back one last time to our options strat tool right here. So what I will do now is I will add another position here. And this time it's going to be a long put. I'm going to buy something. Okay. I'm going to buy something. And this long put is going to be, as far as the put is concerned, out of the money. So at a lower price level. The further I put it down, the less I have to pay for this put. Let's put it at 130 right now. What's happening now? You can see now that our profit loss diagram is kept to the downside or a loss at 417. That's all I can potentially lose because I have this protective put in place. But of course, also my upside now is less than with just having sold the put. You can see it here, my max profit. My next max is the net credit, the 382. But look what happens. If I move this further down, my net credit goes up. And you can put it to a point, hey, maybe I'm comfortable with risking $1,000. I probably would not do it. But in return, I would gain $700 if prices stay above one, in this case, 138. My strike price here. So that's my max credit to be gained. And you can play around with this to find the trade or these strike prices that match your risk profile. And this tool here, Options Trade, is a great tool to simulate this. All right, but let me go back to my slides. Credit spread. I will still collect some credit. It's a net selling strategy, which is great in the current market environment. I will cap my max loss thanks to my protective put that's in place, my long put. And if you look at it, your break-even point is actually quite favorable. In this case, if I set it up like this, selling a put at 139, for example, buying a put at 130, expiration on June 18, my break-even would be 134. We're now priced at 138. So even prices go down even further, I might still be profitable. That's the beautiful thing about these credit spreads. And these works really nice if I'm looking for something of limited risk and I want to benefit from time decay. That means the closer we're getting to expiration, the more my net the options will lose value, the totality of the options will lose value. And this is what I want, basically, because I'm sold some options. I want these options to lose some value so I can buy them back cheaper. It's a net selling strategy. And of course, also if volatility goes down, I will benefit from this as well. And in my view, both debit spread and credit spread are quite similar. You can see here the profit and loss diagram is almost the same. Yeah, have this little downside cap here. Then we get into profitable territory and the profits are also capped. Quite similar, but in the current market environment for USO, I personally probably would favor the credit spread. Why? Because it's an option selling strategy. Premiums are high right now. Selling or net selling might be the better play to do. It's also a short-term strategy. So time decay really works in my favor. It would be a long-term option strategy, time decay doesn't really kick in that much. But if it's short term with expiration fairly nearby, time decay will really help you. And if you believe that implied volatility is going to come down, then also the strategy will be benefiting from this if it's a credit spread versus a debit spread. All right, so this was my little breakdown of these two options strategies. And in conclusion, if I were to trade this particular setup, with my expectation price will be bouncing off this trend channel here from the lower end towards higher price levels, I would trade this with a credit spread. Limited risk. It's suited for my short-term horizon with expirations fairly nearby. Thanks to accelerated time decay and my expectation that volatility or implied volatility is going to come down a little bit as well, which will help my trade.